Major Wall Street firm delivering its 2024 S&P 500 forecast today. Wells Fargo Securities going with 4625. That's just 75 points from today's S&P 500 close. Chris Harvey is behind the forecast. Chris is the firm's head of equity strategy. So you think the market does nothing next year?
A whole lot of nothing.
Why?
Why? Because if you look at things, right, it's really hard to get excited. If we have better growth, then the Fed doesn't do anything. If we have worse growth, then numbers are going to come down. The Fed will eventually cut. The second half will be better, but the first half is going to be really, really sloppy. So we just can't get excited about things. And the other issue is everyone's moved over to one side of the boat. Credit spreads are at all year-to-date tights. Equity market's up 20%. The VIX is at 13. Every time we've gone into a new year with the VIX at 13, we've seen spikes. We've seen the equity market pull back. And it's just not a great setup into 2024.
I feel like the consensus is a little more positive than you are right now. This idea that we might go into another year with no recession. Everyone expected it this year. It didn't happen.
Right.
If we don't have one again next year, that's a soft landing. And the Fed's done raising interest rates and might start to cut, which could be good news.
So here's the problem with that. The cost of capital is a lot higher this year than it was last year, right? And if the cost of capital is higher, multiples can't go higher. The growth that we have is it's okay. It's not great. You can only have a big recovery if you have a big recession, and that just hasn't occurred. So at the end of the day, you're stuck in this catch-22. If things are better, Fed's more hawkish. Things are worse, then numbers come down, and things aren't great there either.
But Chris, so we're in a sub-13 VIX environment, and I hear you that you don't see a lot of upside. The things you're worried about, I think I am too. But do we go to 4650, just kind of dribble higher? In other words, think about the year we've had. Think about the volatility within the lines. Think about some of the dynamics we're going to start the year with, where you've had a NASDAQ rally 14% in 20 sessions. Just kind of curious how you see, because I think a lot of people, especially with the broader and a more constructive potentially rates environment to investing in from an asset allocation perspective, that wouldn't be terrible if it was a nice, smooth, calm road.
Right. So can we go higher from here? Sure, we can go a little bit higher. But I just don't think you can go a ton higher. People have talked about 5,000. I don't see how you get to that level. And if you look at corporate bonds, if you look at the alternatives, there are things that are pretty attractive. And I hate to say that being the head of equity strategy, but you can park money at the front of the curve and make a pretty good rate of return and not put on a whole lot of risk.
So, Chris, we always talk about the market is not a monolith. So do you think that there's pockets within, like, let's say the Russell 2000 or something like that, where you could see different growth and then maybe the Magnificent Seven take a breather for a while?
So we want to be really constructive on small caps, but we just can't get there because there's too much operational leverage and there's too much balance sheet leverage. They're really oversold, but until we see the Fed cutting rates, we can't get there. As far as other sectors, I hate to say it, but it's not so much the Magnificent Seven, but it's the Uber caps are still in a good place. They're not as effective as rates. They have better growth rates, better balance sheets. Valuation isn't horrific. This is not the 1990s, right? And they can still work in that kind of environment. What we want to do is we want to go to the places that are oversold. We just upgraded utilities today. We upgraded healthcare. Those are areas that have good valuations, decent fundamentals, and most people really aren't there at this point in time.
Chris, Guy and I had a conversation last week with the illustrious Liz Ann Saunders from Schwab, and she made a really good point to us, or some of these folks who are calling for a recession and maybe it gets pushed out another year, that sort of thing. And her call has been that there's just been rolling recessions in different parts of the economy, and it's been reflected in the stock market. You can look at the sort of stuff that has underperformed this year in a year that the S&P is up more than 18% or so. How do you, is that making your job harder as a strategist? Karen just asked you about small caps, but there's a lot of things that have been going on under the surface. We pointed out on the show here, if you do think about things in monolithic terms and say, oh, how can the market go higher with the banks acting as bad as they are, that sort of thing, does that give you some hope that maybe, a lot of these folks that have, 5,000 and up targets at the end of 2024 could be right?
Listen, they can always be right. I can always be wrong. The issue, I think you hit on something that's perfect. So just talking about the economy, what we've been talking about is an economic malaise. Right? It takes a ton to bring the U.S. economy into recession. It takes a ton to bring it up to 3%. But you're right. We've had this kind of asynchronous growth. Some stocks, some sectors are going down, others are going back up, and that just makes this kind of lackluster type of growth. So, and we think we're going to see that going forward. And until we see a real washout, and one of the things we were talking about is we go back to Silicon Valley. Silicon Valley was an event. It wasn't a clearing event. a lot of balance sheets, a lot of people still just have situations that they need to clear out. Right? If you look at the banks, you look at the insurance companies, people have duration on, and they're underwater in a lot of these positions. It's hard to put on duration at this point in time, and that's keeping the cost of capital higher. And as long as the cost of capital stays higher, it's really hard for me to get to a much higher price target.